we've got to talk about inflation in Germany. Usually, inflation in Germany refers to the post World War I hyperinflation Weimar Republic stuff. But now we're kind of entering a new era where producer price inflation in Germany just reached 45%, almost 50%, which is insane. I mean, how did that happen?
Right. These are input costs, right? So a producer, a manufacturer has all of these commodity costs and input costs, and they get factored in, right? So producer prices as opposed to consumer prices, that's the difference between two inflation numbers. What the consumer sees as they pay for things as they pull them off the grocery store shelves or whatever. The producer prices, energy's gone through the roof. You look at Ukraine, you look at Russia, you look at the cessation of flows of natural gas into Germany, and all of a sudden they're having to pay a lot more for LNG coming from Qatar, coming from the U.S. That significant jump in prices gets factored in for the folks who are making stuff. What happens to their margins when their cost of the basic materials that go into producing anything are up 45%? Their margins are eviscerated. They can't make any money unless, of course, they're going to pass those price increases on to the consumer. So oftentimes what you'll see is a big jump in producer prices and then a scramble by corporate entities to say, how do we recoup? And it's on the backs of the consumer. So to see PPI, producer prices, move first and then CPI move thereafter, not really uncommon. What are German companies going to do otherwise? So the consumer's next in line, probably not those kinds of numbers, a 45% increase, but to see it move a couple points is still going to be incredibly painful. And this is sort of the undoing of the European consumer.